In this video, I'm going to be talking about the different types of mutual funds that we have. In my previous video, I've already explained what mutual fund is and the different types of mutual fund we have. But this one is a must watch if you want to invest in any kind of mutual funds because we have different types of mutual fund, and if you're not careful, you might just go ahead and buy any one because you don't know what they all entail. So in this video, I'm going to be telling you the different types of mutual funds we have, how you will identify the one that is best for you, and what each one entails, so that at the end you know what you're investing in and what to invest in particularly. So subscribe, like, share. Let's get into it. The first one I'll be talking to you about in no particular order is equity fund. On your platform, you might also find this as an aggressive fund. So it's that is equity fund or is an aggressive fund, whichever one you find on the platform you're using. So what exactly is equity or aggressive fund? Now, from the word equity, equity is anything that has to do with shares and stocks. So it means that this particular type of fund, they are more invested in equities. Now, don't forget that in my previous video, I told you that mutual fund is the pooling of resources together, different people bringing their funds together, handing it over to a professional, and the professional now invest this money for them. So now when you hand your money over to a professional to invest for you and you plan to invest in equity fund, what they do with your fund is about 70% of that funds that you're investing goes into the stock market. So whatever happens in the stock market has a driving effect in your portfolio, and the remaining 30% goes into fixed income instruments like commercial papers, bonds, treasury bills, all those fixed income investments. That means the equity fund has an exposure to the stock market, and anything that happens in the stock market is going to greatly affect your portfolio either positively or negatively. It's a high risk, high return investment because it has most of its investments in the equity market. The higher the risk, the higher return. So this one has more risk and it also gives you more return. And it's for those who have a high risk appetite. Those who have large risk appetite, that means that you can afford to take risk. So if you cannot afford to take a risk on your investments, this equity fund might not be for you. You might just find another one that is for you as you continue to watch this video. So another one is, it is perfect for long term. You might not get a reasonable profit or a reasonable increase in the short term, but if you are staying in this market for a long time, then you will have a good reward for your investments. Another one is that it does not have a fixed return. Yes, if you look at the stock market does not have a fixed return. You don't even know what you're expecting after you have invested, but you know it can either increase and it can reduce. Only that when it increases, the increase might be more compared to other forms of mutual funds. However, it does not protect your capital. Peradventure, there is a decline in the stock market, which is going to affect this particular type of mutual fund. Another one is, it is good for capital acquisition. Why capital acquisition? Because this is not unlike another type of fund like the mutual fund where you can get passive income on a monthly basis. In fact, on a daily basis. I'm still going to get into that. Equity fund is not like that because you can't tell exactly how much you're expecting. So this might not work for a passive income, but it's going to work for capital appreciation. Another one is, you can start with just the minimum of 5,000 naira. So if you're thinking that you need 5 million, 10 million naira to start, no, start from where you are. It's a marathon, it's not a sprint. So with as low as 5,000 naira, you can get started with these investments. And another one I said is investors with high risk appetite. I think I mentioned that earlier. You have a high risk appetite that you can afford to take a risk on your investment, then this might just be for you. And most of the equity funds, the year to date, by year to date, I mean from January to now, I've returned over 40% on the investment. So you understand what I'm talking about when I'm saying equity fund, that it has a high risk, high return. If you have 40% increase in your portfolio just from January till now September, you can understand what that means. Unlike some other funds that you can't even get, no matter what happens, you can't even have up to 25% in your portfolio. So this is a high risk, high return, but at the same time, it doesn't even preserve your capital if there's going to be a loss on this particular investment.